Chapter 16 focuses on the management function of control, including monitoring performance, comparing it with goals, and taking any corrective action that is needed. Along with the control function, we will explain the importance of managing for performance. We will identify 6 reasons for the need for management control, explain those steps, and describe 3 types of control managers use. Controlling. Controlling is defined as monitoring performance, comparing it with goals, and taking corrective action as needed. What you as a manager do to get things done with controlling it shows relation into with the other 3 functions of management. So as a manager, you do these things, and with the control function, you make sure that what was planned, how you did it, and all of that, how did they come together and to the end result. And then we'll talk about what we do in controlling. All 4 functions happen concurrently. That means they happen at once. So why do we need control? Lack of control mechanisms can lead to problems for both managers and companies. So it is important for as managers and employees as companies to make sure that we take a look at the end result and what was the result of things that we put into play and that we've executed, and what was done correctly, what needs to be changed for the future. So another reason why we need to control is to adapt to change and uncertainty. Control systems can help managers anticipate, monitor, and react to changes. Control also helps to discover any irregularities and errors, such as cost overruns, any manufacturing defects, any employee turnover, bookkeeping errors, and customer dissatisfaction. These are all matters that may be tolerable in the short run, but in the long run, they can bring about even the downfall of an organization. Another reason why we need control is to reduce costs, increase productivity, or add value. Control systems help to reduce labor costs, eliminate waste, increase output, and increase product delivery cycles. It also helps to detect opportunities and increase innovation. Controls can help alert managers to innovative opportunities that might have otherwise gone unnoticed. It gives us an opportunity to provide performance feedback. And finally, to decentralize decision making and facilitate teamwork. Controls allow top management to decentralize decision making at lower levels within the organization and to encourage employees to work together in teams. The control process consists of these steps here. Step 1, establish standards. This is where we set a performance standard. What is the desired performance level for a given goal? Standards may be narrow or broad, and they can be set for almost anything. The next step is measure performance. Performance data are usually obtained from 3 sources. 1, employee behavior and deliverables. 2, peer input or observations, and 3, personal observation, as when a manager takes a stroll on the factory floor to see what employees are doing. The third step is compare performance to standards. Management by exception, which is a control principle that states that managers should be informed of a situation only if data show a significant deviation from standards. There are such things that control charts that we can use, which is a visual statistical tool used for control quality purposes. The 4th step in the control process is take corrective action if necessary. So make no changes. You need to recognize and reinforce positive performance or take action to a corrective negative performance. This step concerns feedback, modifying, if necessary, the control process according to the results or effects. This might be a dynamic process that will produce different effects every time you put the system to use. There are 3 possibilities here in taking corrective action if necessary in step 4. They are: you make no changes, you recognize and reinforce positive performance, and finally, you take action to correct negative performance. So let's take a look at this question. a UPS driver fails to perform according to the standards set by the route and traffic conditions. A supervisor rides along and gives suggestions for improvement. This is the blank stage of the control process. So, of the 4 steps that we just discussed, which one is this an example of? If you answered C, take corrective action, you're correct. This is because the supervisor is observing to see why the driver may be dipping below the expected standards, and then a corrective action will be decided. So what are some ways that we can control outcomes? There are 3 that we will discuss, and which type of control is used is based on timing. The first one is feed-forward control. It focuses on preventing future problems by looking at past performance and then planning based on that. So if there were problems in the past with feed forward, you would anticipate them and plan on avoiding those problems. The next one is concurrent control. This entails collecting performance information in real time. Concurrent control entails collecting that performance right then and there as it is happening. This enables managers to determine if employee behavior and organizational processes conform to regulations and standards. And finally, the control is feedback control. We can have feedback control. This amounts to collecting performance information after a task or project is done, and that information is used to correct or improve future performance. Next, we will discuss the 3 levels of control, which are strategic, tactical, and operational, along with the 6 areas of control. So, in order to apply the steps of control in the area you manage, you need to first consider the level of management you are operating at. Are you at top, middle, or first level? Second, you need to take into consideration the resources that you have in your area. These resources can be physical, human, informational, and or financial. Finally, you need to look at your firm. What type of firm are you? Is it manufacturing? Is it service? So once you have done that, you can successfully implement the steps in the control process. Here we have 3 levels of control which correlate to the level of management you are in. So strategic control is monitoring performance to ensure that strategic plans are being implemented and taking corrective action as needed. Monitoring performance, at this level, we monitor performance to ensure that tactical plans, those at the divisional or departmental, are being implemented. And this is typically done by top managers such as CEOs and VP levels of an organization. The next is tactical control, and this is monitoring to ensure that tactical plans, those at the divisional and departmental level, are being implemented and taking corrective action as needed. Middle managers are responsible for tactical control. These are your plant managers, your branch, and your sales managers. And finally, there is operational control. This is monitoring performance to ensure that operational plans, your day-to-day goals, are being implemented and then taking corrective action as needed. And this is typically done by your frontline managers, such as a supervisor, your department head, and team leaders. So within an organization, there are 6 areas of organizational control. They are physical, human resources, informational, financial, structural, and cultural. So the first one of organizational control is physical area. This includes your buildings, your equipment, your tangible products. We can control our equipment, keep track of how much inventory we have, and maintain our equipment systems. Next area of control that we have is human resources. These are controls used to monitor employees, include personality tests, drug testing for hiring, performance tests during training, performance evaluations to measure work productivity, and employee surveys to assess job satisfaction and leadership. Next is informational area. We can control this area. This is controlling production schedules, sales forecasts, environmental impact statements, analysis of competition, and public relations briefings. All are controls and organizations has in various, and these are all in various information resources. Next is financial control. And this is, we want to make sure that we ensure that we are paying bills on time as well as suppliers, and we are getting paid by our customers. You are able to control and monitor if there is enough cash on hand to meet payroll obligations. You need to know what are your debt repayment schedules. The fifth is structural area. This is how the organization is arranged from hierarchical or structural standpoint. Within this are two examples: bureaucratic control and decentralized control. And then finally, we have cultural area. This is an informal method of control. It influences the work processes and the levels of performance through the set of norms that develop as a result of values and beliefs that constitute an organizational control. So we have bureaucratic control that was mentioned a little bit ago, and this is an approach to organizational control that is characterized by rules, regulations, and formal authority to guide performance. This form of control attempts to elicit employee compliance, using strict rules, a rigid hierarchy. There's well-defined job descriptions and administrative mechanisms such as budgets, performance appraisals, and compensation schemes. Decentralized control is an approach to an organizational control that is characterized by informal and organic structural arrangements, which is the opposite of bureaucratic. This form of control aims to get increased employee commitment using corporate culture, group norms, and workers taking responsibility for their performance. So let's take a look at this question. A drug test employed by an organization in its hiring process is an example of blank resource control. If you answered B, human, that you are right. The human resource area of control includes your personality test, performance test, as well as your drug testing. So, the balanced scorecard for perspective. This balanced scorecard establishes goals and performance measures and gives top managers a fast but comprehensive view of the organization via four indicators shown in this visual. The first indicator is financial measures. This is where you take a look at your profitability, your growth, your shareholder values, or you ask the questions: how do we look to shareholders? Are we making money? And what is our growth productivity? It is important to shareholders because if we are making money as an organization, they are making money. Second is customer satisfaction. Priority is taking care of the customer. And this is basically answering the question: how do customers see us? Using a balanced scorecard, we know the answer through market share, customer acquisition, customer retention, and loyalty. Third is internal processes. This is quality. You're taking a look at quality, your employee skills, and productivity, and asking the question: at what must we excel? Organizations need to answer this question so that they meet customers' expectations in addition to the financial objectives of the company. In order to excel, four high-level internal processes are measured and managed. They are innovation, customer service and satisfaction, operational excellence, which includes safety and quality, and good corporate citizenship. Finally, we have innovation and improvement activities. This is learning and the growth, learning for of ourselves and the growth of our companies. So it is asking the question: can we continue to improve and create value to our employees? This is important because motivated employees and positive working environment with a good culture will get the job done. These employees will provide better quality products and better customer service. And this is measured through employee engagement and satisfaction, retention, productivity levels, and the overall organizational environment. So that was a strategy map, which is a visual representation of the four perspectives that we discussed here. So here it is, a strategy map of that visual representation. This it shows a crucial relationship among all of the critical objectives of an organization, and what drives them to perform. So this map shows that relationship. What is the relationship with the company's strategic goals? This helps employees understand how their work contributes to their employer's overall success. One great benefit of a strategy map is that it is a starting point to implement goals. Starting with learning and growth, the arrow and the diagram show the logic that connects goals to internal processes, to customers, to financial goals, and finally to the long-term goal of providing shareholder value. So for example, students can see that the organizational culture, we can see here as students that the organizational culture affects the internal process goals related to innovation, operational improvements, and good corporate citizenship. This causal structure provides that strategic roadmap of how the company plans to achieve its organizational effectiveness. So let's take a look at this question. Joel's sales goal was to improve sales. Which barrier is this a measurement of? If you answered A, objectives are fuzzy, you're correct. These goals are fuzzy, improve sales, but we need to be more specific, meaning that we need to give numbers to these sales goals. So budgets, we're going to talk about budgets next. So these are a way of financial tools for control. So within any organization, having financial control is very important. And some ways that we are able to have financial control is by establishing budgets and knowing what are the financial statements, what our statements are saying, and auditing as we operate. So the first we're going to discuss is budget. So a budget is a formal financial projection. It states an organization's planned activities for a given period of time in quantitative terms, such as dollars, hours, or number of products. Budgets are prepared not only for the organization as a whole, but also for the divisions and departments within it. So one budget planning control is incremental budgeting, and this allocates increased or decreased funds to a department by using the last budget period as a reference point. Only incremental changes in the budget are reviewed. So within this incremental budget, we can identify two types of budget. One is fixed, the other is variable. Also known as a statistic budget, a fixed budget allocates resources on the basis of a single estimate of cost. That is, there is only one set of expenses. The budget does not allow for adjustment over time. So for example, you might have a budget of $50,000 for buying equipment in a given year. So no matter how much you may need the equipment, you cannot exceed that amount. So then we have what is known as a flexible budget or a variable budget, and this allows the allocation of resources to vary in proportion with various levels of activity. That is, the budget can be adjusted over time to accommodate pertinent changes in the environment. So a very important tool for financial control, we just talked about budget. The next one is knowing your financial statements and what your company's financial health is. A financial statement is a summary of some aspect of an organization's financial status. So although there are several financial statements, two that we will discuss are the balance sheet and the income statement. So a balance sheet summarizes an organization's overall financial worth. That is, its assets and liabilities. And we've heard this and we should be familiar with it from our accounting classes. So as you have learned in your accounting classes, this can be monthly, quarterly, or yearly. So the balance sheet takes a look at our assets, which are resources that we control, such as inventory and cash. And it also looks at our liabilities or debt by suppliers, so lenders and others against our company assets. So it is important to understand that the balance sheet by knowing what your assets are against what is owned to you, which is your liabilities. The other important financial statement is an income statement, and it summarizes an organization's financial results, such as the revenues and expenses over a specified period of time, such as a quarter or a year. So why these are important, you learned in accounting to create them. We learn in accounting classes to create them and understand why they are important. But as a manager, you need to have financial control. And as an organization, it is essential you know the financial health of your company so that you are staying within budget and you're maintaining that financial control. So the next financial control tool is audits. So you can imagine that audits of medium and large companies entail collecting and analyzing and interpreting large amounts of information. Because of this, more and more companies are using data and analytics to conduct audits. Auditing is a tool that management uses for decision making, and it is defined as a formal verification of an organization's financial and operational systems. And there are two types of audits, internal and external. External is performed by an outside expert who verify the organization in creating their financial statements. Are they correct, and are they according to GAAP or the generally accepted accounting principles? The next one is internal, an internal audit. So this is performed by the organization's own professional staff, and it is the same as if someone externally did the audit. It is their responsibility to make sure that the financial statement records are accurate. And internal audits also help identify inefficiencies, which in turn help managers and organizations evaluate performance and the control system. So the next few minutes we are going to answer the question, how do you as a manager make a control system successful? And how do you identify and deal with barriers to control? Successful control systems, just like a successful group, have certain characteristics, and there are 5 that we will briefly cover. They are and they are strategic and results oriented, meaning that managers pay attention when developing their strategies or plans, and they make their control standards, make sure that their control standards will measure how well they are doing. The other characteristic is that they are timely, accurate, and objective. Timely means that the information is delivered at an appropriate time, and that can be weekly, monthly, but it is done often. Accurate means that the information should be correct, because if the information is inaccurate, then sales figures, production costs, and rates and so forth are inaccurate, and all these impact the overall financial picture. Objectivity means that the controls should be impartial and fair, not biased or prejudiced, because the sole purpose of the control system is to enhance performance. The third characteristic we have is expectations should be realistic, positive, understandable, and encourage self-control. So what does this mean? They should be realistic, meaning not too difficult nor too easy, because if employees feel that they are easy or too hard, they may not perform up to par, or they may sabotage the performance system. They should emphasize the positives, development and improvement, and not punishment. Expectations should be understandable in that they should fit the people that are involved, and so that they know what to do. And then finally, expectations should encourage self-control, and that is done by encouraging good communication and mutual participation. The final common characteristic is flexibility. Control systems should leave room for individual judgment so that they can modify their work to meet the goal and requirement. Just like anything we do, we are faced with barriers. The same applies in control system, and there are 5 barriers that prevent a manager from producing a good control system. So barriers to control. So one is too much control. But this is too much control can be done by regulating employees on everything they do, from dress code to coffee breaks. This leads to micromanagement, which ultimately leads to unhappy employees. And that is not what we want, because it is counterproductive. Employees do a better job and are much more effective when they have greater job satisfaction and they feel empowered. We can do this by giving employees opportunities to discuss expectations and hearing them out and hearing their input and so forth. Another barrier is too little employee participation. As I mentioned, participation enhances productivity, and it is important to involve employees in planning and execution of control systems, which in turn increases employee satisfaction and morale. Another barrier is overemphasis on means instead of ends. Too much emphasis on accountability leads to pushing employees and resources, and this means pushing them too hard, which results in turnover and or absenteeism. Overemphasis on paperwork can lead to too much focus on the data and the results and not on getting the work done. When there is overfocus here, it can result in falsifying data to meet expectations. Overemphasis on one instead of multiple approaches is the final barrier that we will discuss. Remember, if one area goes wrong and that area or task is dependent on another, this can affect each other, resulting in inaccuracies and not meeting expectations. So it is important to understand that control systems affect each other and must be integrated properly. So as managers, our purpose is to make decisions for our organizations based on the 4 functions of management. It is also to get our employees and others to achieve productivity and realize the results. Productivity is defined by the formula of outputs divided by inputs for a specified period of time. Outputs are all the goods and services produced. Productivity matters because it determines whether the organization will make a profit or even survive. The end of this lecture will focus on the manager's role in increasing productivity. So productivity can be applied at any level in an organization, and it is defined by the formula outputs divided by inputs, where outputs are goods and services produced and inputs are labor, capital, materials, and energy. What does this mean to you as a manager? It means that you can increase your overall productivity by making substitutions or increasing inefficiencies in any other element you see fit. Increasing productivity is important because the more goods and services that are produced, the higher the standard of living. The role of information technology has made it possible for managers to stay on top of the latest developments with the implementation of the Enterprise Resource Planning, or ERP, and this is software systems and information systems that are integrated virtually in all aspects of a business, helping managers to stay on top of those latest developments. Productivity can be increased through processes such as benchmarking. And remember, benchmarking is a useful way to measure your own growth as an employee and eventually as a manager. And a way to measure is that something is to set it against a standard or a benchmark. And another way is through best practices, which is a set of guidelines, ethics, or ideas that represent the most efficient or prudent course of action. Companies often develop best practices internally through managers and employees' positive experiences on the job, and they sometimes adapt the strategies with which other companies have succeeded in similar situations. This concludes Chapter 16.